So in the last video, we talked a little bit about the three monetary policies that the Fed will use in order to control the money supply. We said it's the reserve requirements, we said it's the discount rate, and we said it's the federal funds rate. So now we're going to dive in a little bit more into what each one is and a little bit about how it affects the money supply. So this very first one that we're going to talk about is one of the least common used tools, and that's that reserve requirement. The Fed does not use the reserve or change the reserve requirement ratio all that often because it has drastic impacts on the banking system. So what is the reserve requirement? Well, banks are required by law to keep a certain amount of money on hands for withdrawals. Well, how does a bank make money? Well, the banks make money by loaning out money. So think about it this way. If you have a savings account or a checking deposit or a checking account or anything like that, you put money in the bank, right? You think that bank just holds on to your money and doesn't do anything with it? Heck no. They actually take your money and loan it out to other people. So they're taking your money and giving it out to someone else or loaning it out. They're loaning it out at a fee. So if you put money in, say, a savings account and then you borrow the money from that bank, it's like you're giving the bank money so that way they can loan it to you and charge you a fee to loan it out to you. So banks make money by loaning out money at an interest rate, at a fee. So they're loaning out this money, but they are required to keep some of it in case of cash withdrawals. So you walk into the bank, you put $1,000 in the bank, you walk up to the bank and you say, I need to withdraw all $1,000 today because I need to go buy something. And they say, we don't have your money on hand. What are you going to do? You're probably not going to be very happy. So by law, each bank is required to keep a certain amount in their vault, on hand, in case of withdrawals. That's that reserve requirement. Now the banks must walk a fine line, or they try to walk a fine line, because if they keep too little of that reserve requirement, if they keep too little amount of that money and too much is withdrawn on a day, the bank goes broke. They run out of business. They have to close their doors because, well, frankly, they don't have enough money in their vaults anymore. If they keep too much, the bank is losing money by not loaning out that money. They're losing profit because they could be loaning out more and earning money off that higher interest rate. So now we get into three legal terms. We have the legal reserves, and these are deposits that are held at the Federal Reserve Bank vault. Remember how we said that the Federal Reserve, the Fed, has all those district banks? Well, any money that's held at the district banks as deposited by these commercial banks, that's known as legal reserves. We also have these required reserves. That's the minimum average weekly average legal reserves that a depository institution must hold. Basically, these required reserves are how much must this bank keep on hand or keep around in case of withdrawals. Excess reserves. So the excess reserves are these total reserves minus the required reserves. So the total reserves is how much money does this bank have on hand. And if it's more than the required reserve amount, they can actually loan out that money. So these excess reserves are the amount that a bank can loan out. So how does a change in the required reserve ratio affect the money supply? So a change in the required reserve ratio is going to change the amount of required reserves. So let's say, for example, that the required reserve ratio was, say, 10%, and this bank has $1,000 in deposits. Well, if they're required to keep 10% of that 1,000 deposits, they have to keep $100 on hand. Well, what if we increase that required reserve ratio? And now we increase it to, say, 20%. So if they still have a deposit of $1,000, now they must keep $200 on hand in required reserves, which means they can only loan out $800 versus before they were able to loan out $900. So because of that aspect, now they can because we are changing the amount of required reserves, we're changing the amount of excess reserves. Whereas before they had $900 of excess reserves, now they only have $800 of excess reserves, which is changing the amount that this bank can loan out. Now the next monetary policy instrument that the Fed uses is the discount rate. change in the discount rate is used a little bit more often than this required reserve, or change in the required reserves. So what is the discount rate? Well, we've mentioned it before, but the discount rate is the interest rate that is charged to banks by borrowing from the Fed. So if the banks, let's say that they don't have enough excess reserves to loan out more money, but they still want to make more loans. Why does a bank want to make loans? Because they make money off of making loans. They make a profit off of making loans. So they want to loan out more money, but they don't have the excess reserves for it. Well, how can they get more money? Well, they just borrow it from the Fed. Well, whenever they borrow it from the Fed, they borrow it at this discount rate. So let's say, for example, they're borrowing it at this discount rate, and that discount rate is, let's say, 1%, but then they can loan out that money at, say, 3%. Well, they're borrowing it at 1, loaning it out at 3, making a profit of 2% in between. So the lower the discount rate, the more enticing it is to borrow from the Fed. So if the interest rate, the discount rate was, say, 1%, and you could loan it out at 3%, why not borrow from the Fed? Why not use the Fed's money to make more money of your own? So the lower the discount rate encourages banks to borrow more. Therefore, they have that more excess reserves. They loan out more, causing more loans. Now, the last aspect that they change, or another aspect that they can change, is the federal funds rate. So the federal funds rate kind of goes along the same lines as this discount rate. And the federal fund rate is the interest rate that is charged whenever banks borrow from other banks. So let's say that you're in a banking system, and at the end of the day, each bank must have enough of these required reserves on hand. They must have enough of those required reserves in order to maintain and be legal. If they don't have enough money on hand, if they don't have enough of those required reserves, they need to borrow that money from somewhere. So they are going to borrow it from the Fed. The Fed is meant mainly to, on this discount rate, is mainly meant for you to borrow money to loan out again. But let's say that you don't have, the banks loaned out too much money, they don't have enough required reserves. Where can they do it? Where can they get that money from? They can't borrow it from the Fed, but they just borrow it from another bank on a 24 to 48 hour loan. They borrow it on a what's known as a short-term loan. And why are they borrowing it? And they're borrowing it at this interest rate known as the federal funds rate. It's the amount that they can borrow from another bank. And the lower the federal funds rate is, the more enticing, the more willing that banks are to risk not having these required reserves. Because if they don't have these required reserves, well, we'll just borrow it from another bank at a low interest rate if the federal funds rate are low. But what if that federal fund rate gets rather drastic? Let's say it's 10%, and you can loan out money at, say, 3%, but now this federal funds rate is at 10%. Well, now you're kind of working against you right there, because you're not now going to be borrowing at this federal fund rate of 10% because you overspent, and you're only earning 3% off of those loans. So just a quick recap. Each bank is required to keep a certain amount on hand, and the more that they're required to keep, the less amount of loans that they will make, because they have to keep more of that deposits on hand. We have the discount rate. The discount rate is the interest rate charged by the Fed. The lower the interest rate, the more enticing it is to borrow from the Fed and to loan out to somebody else. So the lower the interest rate, the more loans you're going to make. The last one is this federal funds rate. Federal funds rate is the rate that you borrow from another bank. You're going to be using this federal funds rate as if you run out of those required reserves. You don't have enough required reserves on hand, so you borrow from another bank. The lower that federal funds rate is, the more that banks are willing to risk not having enough of those required reserves.